The most powerful economic institution in America was born because Wall Street ran out of trust. Today, the Federal Reserve sits at the center of the American economy. It does not pass tax laws, it does not build roads, it does not send checks to households. Yet, a single sentence from the Fed can move stocks, change mortgage rates, strengthen or weaken the dollar, alter hiring plans, and determine whether money feels plentiful or tight. That is the strange power of a central bank. It influences the economy by changing the conditions around it. To understand how the Fed became this important, start before it existed. In the late 19th and early 20th centuries, the United States was a giant industrial economy with a fragile financial system. Banks were local, credit was seasonal, money flowed toward farms during harvest time, then back toward New York. When fear spread, depositors ran to banks. Banks pulled loans, and the whole machine seized up. Then came the panic of 1907. A failed speculation, collapsing trust companies, frightened depositors, and a plunging market pushed the financial system toward disaster. The United States had no central bank to stop the panic. So the rescue fell to one private man, J.P. Morgan. Morgan gathered bankers in rooms, forced deals, organized liquidity, and helped decide who would survive. That was the warning. A modern economy could not depend on one aging financier locking Wall Street executives in a library until they agreed to rescue one another. The Federal Reserve Act was signed in 1913. The new institution was designed as a backstop, a lender of last resort, a source of elastic currency, a way to keep bank panics from turning into national collapses. It was not created to be the main character in every economic story. It was closer to financial plumbing. If the pipes worked, most people would never think about it. But plumbing becomes visible when the house floods. The Fed's core power came from a simple fact. Money has a price. That price is interest. When interest rates fall, borrowing gets easier. Homes become more affordable. Companies can finance expansion. Investors take more risk. Asset prices often rise. When rates rise, the reverse happens. Mortgages bite. Credit cards hurt. Business plans get shelved. Weak companies start to break. The Fed does not directly set every rate in the economy. It guides. The short-term rate banks charge each other overnight, then uses its tools and its credibility to pull broader financial conditions in the direction it wants. Banks read it. Bond traders read it. Mortgage markets read it. The world reads it. That is how an overnight lending rate becomes a national economic lever. But the Fed did not become central because it always succeeded. It became central because its failures were catastrophic. During the Great Depression, thousands of banks failed, credit collapsed, and prices fell. The Federal Reserve had been built to prevent banking panics, but it did not stop the collapse. Economists still debate the details, but one lesson became unavoidable. When the central bank fails, inaction is not neutral. Doing too little can be as consequential as doing too much. That failure changed the meaning of the Fed. It was no longer just a bank for banks. It was a guardian of the money supply, the credit system, and confidence itself. World War II pulled the Fed in another direction. The government needed cheap financing to fight a global war, so the Fed helped keep interest rates low and stable. That made borrowing easier for the Treasury. But after the war, inflation pressures rose, and the Fed faced a question that still matters today. Should a central bank serve the government's borrowing needs, or should it fight inflation even when politicians dislike the pain? The 1951 Treasury-Fed Accord answered that question. It separated debt management from monetary policy and laid the foundation for the modern independent Fed. From then on, the central bank had more room to raise rates when inflation demanded it, even if the White House or Congress wanted cheaper money. Independence made the Fed powerful. Inflation made it famous. In the 1970s, the American economy entered a miserable mix of weak growth, oil shocks, and rising prices. Inflation was not just a number in a report, it was a daily experience. Paychecks lost value. Gas lines became a political symbol. Workers demanded raises before prices rose again. Businesses raised prices because they expected costs to rise. Inflation became psychological. Paul Volcker took over the Fed in 1979 and chose force. The Fed shifted its operating procedures and let interest rates climb to punishing levels. Credit tightened. Housing and manufacturing suffered. The early 1980s recession was brutal. Unemployment reached nearly 11% in late 1982, but inflation broke. That episode fixed the Fed in public memory. It showed that the central bank could do something elected officials rarely can: impose broad economic pain now to restore stability later. Volcker's Fed showed that credibility could become a weapon. If people believed the central bank would defend the value of money, inflation expectations could change. The Fed was no longer just reacting to the economy, it was shaping belief. Then came the era of the stock market. Under Alan Greenspan, the Fed became the institution investors watched most closely. After the stock market crash of 1987, the Fed moved quickly to provide liquidity. When long-term capital management nearly collapsed in 1998, the New York Fed helped coordinate a private rescue without putting Fed funds at risk. The message was not explicit, but markets heard it. When financial stress threatens the system, the Fed may step in. That belief became known as the Greenspan put. A put option is insurance against asset crashes. The phrase meant investors believed the Fed would cushion severe market declines with easier policy or liquidity support. This was a major shift. The Fed was not only managing inflation and employment, it was becoming the emergency room for financial markets. The 2008 financial crisis made that role permanent. The housing bubble burst, mortgage securities collapsed, major financial firms failed or nearly failed, credit markets froze. The panic did not look like people lining up outside small banks. It looked like institutions refusing to lend to each other, money market funds under stress, securities markets breaking, and fear moving through the global system at electronic speed. The Fed cut rates towards zero. Then it went further. It created emergency lending facilities. It supported funding markets. It bought huge quantities of treasury and mortgage-backed securities. This was quantitative easing, using the balance sheet to push money into the system and drive longer-term borrowing costs lower when short-term rates could not fall much further. Before 2008, the Fed's balance sheet was roughly under $1 trillion. After years of crisis response and asset purchases, it reached several trillion. After the pandemic response, it approached $9 trillion. That changed how people understood the Fed. The central bank was no longer just setting the price of overnight money. It was shaping liquidity across the financial system. It was influencing mortgage markets, bond markets, bank reserves, and investor risk-taking on a scale earlier generations would have found extraordinary. COVID-19 solidified the transformation. In March 2020, the economy stopped, businesses closed, travel collapsed, markets panicked. Investors sold even safe assets to raise cash. The Fed responded with stunning speed. It lowered rates to near zero and made massive asset purchases. It created emergency facilities for corporate credit, money markets, municipal finance, small business lending support, and global dollar swap lines. The central bank had become the immediate first responder for the financial system in crisis. Congress spent money, the Treasury borrowed it, and the Fed printed the money into existence. It kept credit flowing and prevented the pandemic from becoming a full financial breakdown. This is why every crisis now seems to pass through the Fed's doors. When liquidity disappears, the Fed is expected to create it. When markets seize up, the Fed is expected to unfreeze them. When inflation rises, the Fed is expected to crush it. When unemployment climbs, the Fed is expected to soften the blow. That expectation is the real center of the story. The Fed became the center of the economy because modern economies run on credit, and credit runs on confidence. A dollar today is not just paper or a bank balance. It is a promise about tomorrow, that wages will buy goods, that loans will be repaid, that banks will open, that markets will function, and that inflation will not devour savings. The Fed stands behind that promise. This power has costs. Low rates can encourage bubbles. Emergency rescues can reward risk-taking. Tight policy can destroy jobs. Easy policy can feed inflation. Asset purchases can blur the line between monetary policy and fiscal policy. The Fed can stabilize markets, but it cannot build houses, fix supply chains, write tax law, or make an economy fair. That is the paradox. The Fed is treated like the center of the economy because it controls the most important price in the economy, and the price of money. But money is not the whole economy. It is the bloodstream. The body still depends on factories, workers, technology, energy, politics, trade, and trust. Still, when the Fed moves, everyone feels it. A family deciding whether to buy a home feels it. A startup trying to raise capital feels it. A bank deciding whether to lend feels it. A retiree watching bond yields feels it. A president facing inflation and re-election feels it. There is no escape. The Federal Reserve did not become central by conquering the economy. It became central because every modern crisis exposed the same truth. When credit breaks, the economy breaks. And when credit breaks, the country looks to the institution that can create money, change rates, and speak directly to fear. The Fed began as a solution to bank panics. It became the manager of money, then the fighter of inflation, then the backstop for markets, then the crisis authority everyone expects to act before the damage spreads. That is how the Federal Reserve became the center of the economy. It became the one place everyone looked to when confidence and trust inevitably broke down.